So that concludes reading the order flow. So let's hop on over to the next topic, which is order pairing, and we're going to be talking about price ranges. Now, the foundation of trading is order pairing. Pairing buy stops up with sell stops or sell stops with buy stops, and that is all the market does. An obvious and significant high to low in the market where sell stops rest below the low of the range and buy stops rest above the high of the range. So that means in bearish order flow, we look for the market makers to run stops at the high of the range by accumulating those buy stops so that they can move price down to the low of the range to pair the buy stops up with the sell stops resting below that range. And vice versa, in bullish order flow, we look for the market makers to run stops at the low of the range by accumulating sell stops so that they can move price up towards the high of the range to pair those sell stops with the buy stops resting above the range. Now, trading with ranges in the direction of the higher time frame order flow. When we are bullish, look for the range low to range high, and then you can accumulate more longs around the 50% level. And when bearish, look for the range high to range low, and you can accumulate more shorts around the 50% level. Now, when you're trading with ranges against the higher time frame directional order flow, you take profit at the 50% of the range and with internal range liquidity. So over here we've got a crude schematic of a range, right? We've got a range high over here, range low down here. Now think about the order pairing again. We want to pair up those sell stops with the buy stops, right? The sell stops are resting below an old low and the buy stops are resting above the range high. Now we want to pair it up on a key level, right? We've got this discount array over here. We can see sell stops are being accumulated, hitting that higher time frame discount PD array, and then price pushes up and pairs up those accumulated sell stops with the buy stops resting above that range high. Over here we've got an example. We've got a Euro USD 5-minute chart. Now let's go over this entire chart and build the narrative of what is going on over here. First and foremost, we've got our drawn liquidity, which is higher, right? We've got a nice line over here. We want to trade towards that line. So New York midnight open, always draw out your midnight open line, the daily open line, right? We can see London session trading into Asia session lows. So we're removing the sell stops from down here. So that is already gone, right? So there can be buy stops above this range high. We can see prices slowly moving up. And now when we are trading New York session, we always want to be buying in discount after the low of the day has been created, right? So we wait for that range high and range low to get created. So we've got our low down here, up into the high. We draw out our Fibonacci so we know where discount and where premium is. We can see the OTE levels over here. We've got a nice discount array, this fair value gap, right? And then spot this range low and this range high, which gets created before hitting that key level down here, right? So what we want to do is pair up the sell stops and push price up higher and pair them up with the buy stops, right? So that is order pairing, and we want to hit a key level below the range low for it to be high probability. And we can see that over here we dip into discount, OTE levels hit, discount level hit, right? Range low, sell stops accumulated, and then price pushes up higher into the range high where the buy stops rest. So orders are paired from low to high. So over here we've got another example, right? We've got the Euro USD 15-minute chart. Again, we want to be sellers in premium and buyer in discount as always. So we map out our swing low here and our swing high. And we've got another high over here in the range, right? So we're going to use this high over here. It's resting just below that key level. So we always want to pair up our buy stops with a key level above it, and vice versa also for a bear scenario, right? We want to pair up our sell stops with a higher time frame key level below it. And we can actually see that happen over here, right? We're engineering liquidity. We have some relatively equal lows down here. As always, mark out your New York midnight opening price. And you can see price moves up, manipulating higher into that key level. And simultaneously, what happens over here, once we hit that key level, we are also accumulating the buy stops above that range high, right? Once that is accumulated, you can actually see the displacement happening. So there is a willingness to trade lower. So this fair value gap is going to be key to continue down lower, right? So the buy stops are paired up into a key level, that is important. Then price retraces back, and then your opportunity for sells are within this fair value gap. And in the end, price drops lower, and now we have those accumulated buy stops paired up with those sell stops resting below here. Here we got a crude schematic of a bearish scenario. So vice versa, we've got our discount and premium, right? We've got a higher time frame premium PD array over here. Again, we have a range low. This is where the sell stops are resting. Now we've got a swing high up here as well. This is where the buy stops are resting. So we want to pair up, again, those buy stops into a high time frame key level. So we're accumulating buy stops, hitting that premium PD array, and then once that is accumulated, we want to push price lower into that range low, pairing up those buy stops with the sell stops resting below the range low. So over here we've got a Euro USD weekly chart. As always, mark out your premium and discount of the range, right? So we know where we are. Are we in discount or are we in premium? Over here, price moves up. This is the premium area. You can see that over here, running these buy stops as well. So what is going on? We want to hit a key level, right? So again, order pairing, we want to accumulate those buy stops in a key level. So we've got this high time frame key level, which is a daily volume imbalance, actually a weekly volume imbalance, because we are on the weekly chart. So we hit that weekly volume imbalance. Now we're accumulating buy stops above an old high and hitting that key level. That is important. Where is the range low? Right, from this low up until this high. So we're pairing up those buy stops in a key level, and then we want to pair up those buy stops on those sell stops below the range low. So where is your draw on liquidity after you hit those buy stops? So let's zoom in a little. We've got a higher time frame key level to the left of us, right? We've got that weekly volume imbalance fully filled up. And what is going on over here? We've got a range low and a range high. So what happens above that range high? We want to accumulate buy stops at that range high, right? And then we want to pair up buy stops with the sell stops below the range low here. Where will your eye go, right? If we take the buy stops, we want to go for old lows. Let's say this one down here, and eventually this one down here. There's sell stops resting here. Let's zoom in a little bit. Now we're on the daily chart, right? So in the weekly narrative, we have accumulated buy stops above an old high into a key level. You can see a market maker model actually, right? We've got a fractal market maker model. We've got a bigger range over here. Price comes back into it, another accumulation phase here, and then we run those buy stops. So we can go for this low, so market maker sell model, and we got another bigger market maker sell model over here, because price is fractal, right? There can be multiple market maker buy and market maker sell models within one range. So a higher time frame bullish retracement is a lower time frame range high to a range low. So how does that look like? We've got multiple retracements over here, right? So once we hit those accumulated buy stops, right, and then we want to trade lower, every retracement is an opportunity to go short, right? And we can see retracement number 3 here. We've got another retracement, and here we've got another retracement until we eventually hit those sell stops over here. Now let's zoom in a little bit on those retracements, right? What are we going to be looking for? So this is a 4-hour chart, right? Previously we were on the daily chart, and we were looking for all those retracements on the higher time frame, and now we're going to zoom in a little bit on the 4-hour time frame and see how we can catch an entry. So first of all, we want to be looking for the range, right? Where is the range high and where is the range low? Because we want to couple up those buy stops with those sell stops. So marking out those buy stops, right? The range high, we can see buy stops are taken. We've got the range low over here. So we're taking out those buy stops. Now let's mark out the weekly opening price, because we are on the 4-hour chart, right? So the week starts off trading lower, and then we run that range high. So trading above the weekly opening price, right? Same as on the daily opening price. It's ideal to sell a weekly candle above the weekly opening price. And you can see that over here, buy stops are taken out above that weekly opening price. Let's focus on retracement number 2, right? Where is the range we need to trade from? If your eye went to this part and to this part, that is correct, right? There are buy stops resting above these relative equal highs. You can see that retracement on the daily taking out those buy stops, right? So we're accumulating buy stops over here, and then we have sell stops resting on the range low. Again, mark out that weekly opening price, see where the retracement happens, ideally above the weekly opening price, pairing up those buy stops, and then the rest of the week can decline lower. So if you're unsure where the weekly candle might draw into, you can wait for a retracement on the daily, right, taking out buy stops, and then the rest of the week should be clearer for your draw on liquidity. Retracement number 3, again, try to spot where the range high and where the range low is. Right, your eye should go to this high over here and these lows down here. Again, at a high, buy stops, right? We can see that over here. Buy stops accumulated, and now we want to pair up those buy stops with the sell stops. Marking out the weekly opening price, again, we want to be a seller on the higher time frame above the weekly opening price. So we're pairing up the buy stops up here, and then price declines lower, and this is that daily retracement, right? On a weekly chart, the daily retracement, and then you try to catch this move down, pairing up the buy stops with the sell stops. So over here we've got a monthly chart for ES, right? First of all, draw out your premium and discount. As always, we need to know where are we in the range, and key thing to note, we want to see SMT, right? So we have SMT on this low and this low. So we know there is a high probability that we are gonna trade higher from here because we hit a internal range liquidity pool, right? That monthly fair value gap over here. So how does that look like on a lower time frame? Let's head on over to the daily because that is a lower time frame than the monthly. It's again premium and discount, right? This low up until this high. We want to be looking for opportunities once we hit discount of the range. So we can see that over here, right? We've got another SMT formed, so it makes it even more high probable we're gonna trade up higher. Mark out your external range liquidity, right? Over here, buy stops are resting above here. So we want to go external, but we can go from internal to external. So if we zoom in into the 1 hour chart, how does this look like, right? We've got that external range liquidity where those buy stops are resting. Just like in the previous slide, right? This is on a 1 hour chart, and then we have that fair value gap on the daily time frame over here. So how are we going to look for an opportunity? Ranges are fractal as well, so what happens on the daily, monthly can also happen on the 1 hour, on the 15 minute. So now we need to spot our ranges, right? So first of all, what happens in this whole narrative? We are aiming for the external range liquidity up here, but we want to pair up sell stops before we go to those buy stops, right? So over here, we take out this all low, which means we are accumulating those sell stops to pair them up with the buy stops above here. And where does the opportunity lie, right? In the retracement, just like we showed on the daily chart earlier. Now we can do the same thing on the 1 hour chart. So what do we notice over here in this retracement, right? We've got a range again, right? Sell stops resting below that old low, and we want to pair up those sell stops with the buy stops on the range high. So fractally, the same thing is happening over here, right? On the higher time frame, it happened from old high to old low, and now here the same thing. We're accumulating those sell stops for pairing it up with the buy stops. Zooming in a little bit more. As always, mark out your daily opening price. Ideally, be a seller below daily opening price and a buyer above it. And we can see below daily opening price, sell stops get accumulated on this old low, and then we're pairing it up with the buy stops above that range high. Now we just covered this little retracement over here, right? And what do we see over here? Do we see something similar happen? If your eye went to this low and then up until this high, that is a nice spot, right? We've got a key level again, and then we want to pair up sell stops in a key level to go to the buy stops on that range high, right? So zooming in again, right? We've got those sell stops down here on the range low. You see that accumulation of sell stops over here, breaking up higher, and then we are good to go higher. We're respecting those down close candles as well, right? Using the PDRA matrix, what we learned in the previous video on how to read the order flow. And once we accumulate those sell stops, we want to pair it up with the buy stops, right? This above here. So now let's talk about counter trend trades and small scalps. And we're going to be specifically talking about the MMXM traders Twitter model, the X model. So here we have the tweet, right, outlining what the exact model is. We want to see a previous day high or low, that is an external rate liquidity pool, into a 1 hour bullish or bearish fair value gap, which is internal range liquidity. Then we wait for a 15-minute market structure shift with SMT and only short above New York midnight or long below it, right? That is a complete model. So now let's dive in a little bit deeper on how to use that. So first rule of the Twitter model, the X model, right? We want to see external range liquidity purged first, which is the previous daily low or a previous daily high. So in this occasion, we're looking at that previous daily low over here. Now, what are we going to be looking for? Our range, which would be 50% of the range, right? That's what we want to target. We're going to be using previous daily high as that range. So previous daily low rate, and then we're using this entire candle as our dealing range for our take profit into internal range liquidity. So if I mark out the 50% level, that's over here in the middle of the candle, and then we'll zoom in onto the 16-minute chart, and we're going to be looking for that 1 hour fair value gap, right? That is the target, and it has to be at or below 50% of the range. And that is where we want to take profit. So we're not holding until previous daily high. This is a counter trend trade or a scalp model. So we're aiming for 50% of the range. We've got that fair value gap over here, right? That is what we're going to be targeting after previous daily low has been ran. So zoom in a little bit more on the 15-minute chart, because here we need to wait for a 15-minute structure shift, right? So where does that occur? We first of all draw out our New York midnight opening price, right? We wait for a 15-minute structure shift. We can see that actually happening over here, right? Candle closes above this old high, and we have SMT on the low. This is key. We need to see that SMT, otherwise no trade. You can see price dips back into the breaker and order block over here, and then price pushes up willingly into that internal range liquidity pool, that 1 hour fair value gap, right? You can take profit over here already or wait until 50% of the range, but I would advise taking profits in the 1 hour fair value gap, as that is the draw on liquidity. We also have a weekly model, and this is a bearish example. So this is going to be previous weekly high run, so external range liquidity, right? Then 4 hour or 1 hour bullish fair value gap, that is the internal range, that is the draw on liquidity, right, the target. And then we're going to be waiting for a 1 hour or a 15-minute SMT, market structure shift or change in the state of delivery, and then short at or very close to the weekly open. And for a bullish scenario, we're going to be running previous weekly low, and that is that external range liquidity, then 4 hour or 1 hour bearish fair value gap as our draw on liquidity, and then we're going to be waiting for a 1 hour or 15-minute SMT, market structure shift or change in the state of delivery, and then long at or very close to the weekly opening price. So we got a nice example over here, right? We've got the weekly chart. We're going to be waiting for a weekly low or a weekly high to get rated. Over here in this occasion, weekly low gets rated. So we're going to use this entire candle, right? We're going to be using the weekly low into the weekly high as our dealing range. So we're going to be targeting that 50% level of that candle. Previous weekly low ran over here. Let's zoom in a little bit more into the 4-hour chart, right? So this is the weekly model, and we're going to be using weekly and 4-hour PD arrays. So over here, after we run that weekly low, we want to aim for a 4-hour fair value gap, which is one over here, right? So we take out the sell stops, right? Accumulating sell stops, and then pushing price up into internal range liquidity. So external to internal, and we want to take profit around the 50% level of that entire range. So if we dive into the 60-minute time frame, the 1 hour time frame, we've got the same range, right? From range high to range low. Mark out your weekly opening price. You want to take profit at or close to the weekly opening price. You can see SMT, right? That is important. We want to see SMT. We form it on the 1 hour, then a market structure break, and then price retraces back in. And if you look at order pairing, right, we can see the same thing. We can see this range low gets liquidated and then paired up with the buy stops above it. And over here, you should take profit. Now, what if there is no 4-hour fair value gap? Then you drop into the 1-hour time frame to see if there's an internal range liquidity pool and a 1-hour fair value gap. If there is not any on the 1 hour, we do not drop below the 1-hour chart. Then there is no trade. So let's see over here, right? The 1-hour chart from Euro USD. Previous weekly high got rated. Over here, we're breaking down lower. We've got a volume imbalance over here. So we're rating external, right? And then we want to be targeting 50% of the entire range. And then we have this line over here. This is the 50% level. And we have that 1-hour fair value gap where we want to take profit, right? So 1-hour fair value gap around 50% level. That is your take profit. Here we have another example. Euro USD 4-hour chart, right? Range high into range low. Running those highs up here, and then we have a 1-hour fair value gap down here. So we want to be looking to trade towards that 1-hour fair value gap.